All right, a special treat today. We've got Tech Trader joining us live from the beautiful Dominican Republic. Good morning.
Good morning. I hope you can hear me okay, but I look like I have pretty good Wi-Fi right now.
Yeah, it looks A-OK to me. I don't hear any hiccups from the audio line, so it looks like we are able to roll. And it's good to hear from you again. We haven't talked in quite a bit. I think it's a good chance to maybe get caught up on some of the tech earnings. But before we dive into that, why don't you give me an overall grade, if you will, on the earnings season so far, now that we're, I guess we'll call it over the hump of earnings?
Sure. So, I think for the average stock for most participants, it's probably like B plus A. For me, it's A plus. This is I pretty much dreamt up this earnings season, and you don't usually get what you dream up, but so far it's been pretty close.
Well, why don't you give us what you had expected coming into the earnings season and how it's played out, because it may not jive with everybody who's listening. They may not be up to speed as to what you had thought it would be.
Yeah, well, what I've been waiting for is three things. One is FANG to either quit reporting as good reports and rising on those good reports, or have still good reports that don't go up anymore, or just flat out miss, right? But honestly, I sort of thought my setup was we would finally get the FANG and sort of the over-bubbled cloud contingent stocks to still report well, but not get any lift, and in fact go down on that. And then adjacent to that or tangential to that, I thought we would get some buying in value tech, other value, the stuff that really should have gone up and should have performed with the market, or at least with the very thin leadership of the market, that just hasn't really done much for the better part of a year or two or three. There's some theses I've been playing. I've written a lot about 5G, fiber optics, Twitter, various things like that. But yeah, the one thing I wasn't sure, I really did feel like we would have a very, very substantial rotational move, either starting this earnings season or through the end of the year, and if it didn't hit then, that would end up being the theme of next year. And so we're definitely seeing rotation. We're definitely seeing very real sticky rotation. And the healthiest thing I've seen is that we also put in more than a 10% correction even to the S&P. The NASDAQ and the Russell and the SOX were down. There were indices down 20%, 17 to 22%. So we also got a good correction. We kind of reset everything, and at the same time, the world isn't ending. What I mean by that is, economic numbers I still think are pretty good, probably better than most people think. There's a lot of talk of recession next year. The tariffs are really going to hammer economic growth, blah, blah, blah. Tariffs might be 0.2 or 0.3% against GDP. So that's my number. Some people have a much, much bigger number. I don't think it's that big. In fact, I saw a study, somebody saying, hey, so Harvard or Yale or some Ivy League school did some study of 143 countries that did tariffs, and it hurt their GDP, it hurt their economic growth, blah, blah, blah. Well, here's the difference. There's a huge difference between every other single country in the world doing tariffs in the United States. And the reason is because we very few countries could basically go completely isolationistic and support themselves. The United States could. Very few other countries could do that. And I'm not advocating we go completely isolation mode, kind of a McCarthyism type era. But post World War II, United States GDP growth was probably the strongest in the history of the country from roughly, 1948 to 1968. And those 20 years, the U.S. was probably the most isolationist it's ever been in its history. And so I would say the study that was done on 143 countries or whatever it was Well, if the study isn't about the United States, it's kind of meaningless, because how our country works and how our tariffs works are completely different than pretty much everybody else, because most other countries need the tariffs. We don't really need the tariffs. So we could talk all about that. The point is, my main point is I think we had a much needed correction, and for once the stocks that kind of deserve to go down, again, Nvidia went down, you tell me, 120 points from highs, something like that, went down 35%. That was a very deserved and long awaited drop. Amazon probably went down 500 points, which is maybe 20%. Again, very long awaited, much deserved drop. So we finally got a correction where the stuff that sort of needed to go down did. And then we're starting to see this is like not even inning one. This is like halfway through inning one of what I think a rotational move will be. So you literally couldn't be a better setup, or couldn't be a better earnings season from my perspective. But I think really for active money managers, I think for people out there trading, also we've seen volatility increase. Here's the last thing I'll say. So what was sort of the fast money belief? Fast money belief was, and I like to make fun of some of these guys. Their belief was, oh my God, if you lose Apple and you lose Microsoft and you lose FANG, look out below, because there's no support for the market. Well, my view, and it's been my view for about 2 years, is the only time you see lots of other stocks go up is when one of the FANG names drop. And it's because the algorithmic trading sucks so much market cap into the FANG stocks when they're going up, it doesn't leave anything for anybody else. So the only way, again, in the world we live in right now, the only way we can get 20 or 50 or 100 or 200 stocks to go up that have been left behind or more is to basically take a lot of market cap out of the FANG names. And then the last thing I kind of heard, like the popular media guys talking about, was, well, Apple's the last man standing. Apple's the last stock supporting this market. Oh, if Apple breaks, this whole thing's a house card. It's going to implode. Well, no, it's not. In fact, we're going to have a much healthier market if Apple probably sells off the same amount as FANG, because then there's going to be plenty of other stocks with really good earnings reports that deserve to go up, that haven't gone up for a year or two, that can go up a lot. So that's what we're seeing. Apple finally went down on earnings report, and it didn't really hurt the market that much. We're kind of seeing some post-Apple report selling, I think, today. But, there's still plenty of companies doing very, very well. There's still plenty of economic growth. There's still plenty of sectors and subsectors that are going to have really, really good growth cycles that maybe kind of missed out on the FANG growth cycle. So that there's plenty of stuff out there to be positive about. And I think the fear got a little too extreme. Sentiment got very low. We did not get my sentiment low retest, even though the market went to successively lower lows. I don't think sentiment ever went below like the October 11th or October 10th or whatever the first big sentiment low in October was. It never retested. That was actually extremely bullish over time, like days to weeks. So anyway, very, very good. I'm looking at things. In fact, I bought, you want to have a live trading call, I actually bought some AOI within, I think, 3 minutes of me joining the call. So I'm not expecting them to have a good report. I just like, hey, they're going to give me AOI at 1860 or 1853 or 18. It's honestly kind of hard to see on my iPad. I think I got 1858 or something like that. And hey, if it goes to 1458, that's fine. I'll buy more. But the bottom line is, AAOI is sort of the antithesis of FANG. So everybody loved it at 90. Now probably everybody hates it sub 20. It could go lower. They could miss. But we're in a period where I think if companies like them that have already gone from 90 to 18 miss, I'm not really sure if there's a ton more downside. Anyway, we'll have to see. I also like how the rest of the fiber optic stocks reported. So anyway, I'll end my diatribe or my review on sort of market conditions at that point and let you take over.
All right, so is part of your analysis on AAOI, why we're down, is that, you think, due to kind of the spillover in Apple?
Well, AOI does have a very large percentage of their business data center / Facebook. So there could be some thought over the last few weeks that they've had some issues with maybe Facebook or with data center, and then there are some things that I think some tech people that like to focus on tech like me should be aware of. Amazon Web Service is not growing 89% anymore. It's growing 49%. Azure, I can't remember the Azure number, but I don't think it was as high as it's been certainly the last 2-3 quarters. So, the cloud or the big cloud infrastructure stories are probably kind of due for a slowdown / reset as well. Excuse me. AOI, I think it's a little bit misunderstood. So, basically, to me, AOI is very similar to Acacia. So when Acacia was largely a hyper growth but one product company, it had a very, very hyper growth cycle, and the stock did very, very well on sort of just a momentum trading push. But really, guys like me, I did not like Acacia. When Acacia was a $65 stock going to 125, I didn't like it. In fact, this was pre-briefing, but I was recommending and shorting Acacia. And then when I joined briefing, and this was, I'd probably been in briefing a year to 18 months. You guys could go look. I put a short out there on AOI, and I called peak earnings on it, and that short worked very, very well. And then I went long, I want to say mid to high 20s, and the stock went up about 20 points. And I think I largely exited that trade. I haven't really, and I started maybe adding to it again, high to mid 20s, just a tiny little bit. But I don't know, 1850 feels pretty good. I just think it's kind of misunderstood. I think they will kind of do a similar thing to Acacia, where they're now going to, for the next year, probably broaden their customer base. So they'll probably broaden their customer base. Their growth will probably slow, or it already has slowed from what it was. I think the company diversifies itself a little bit and maybe starts trading with maybe more of the traditional fiber optic space, which, by the way, will probably end up being a good thing for it once it finally gets to whatever bottom it's going to get to. So I either think it's either gotten to the bottom that it's going to get to, or they have one more bad quarter, missed numbers, guide lower, and they flush it to whatever they're going to flush it to. I think that flush will be short-lived. And I think, put it this way, I think you basically buy it here. This is what I'm doing. I'm basically buying it here with the belief that I almost don't really care how much lower it goes. Because and then I said the same thing about the market when we were about 85, 90% done with the sell-off. I said, look, wherever the market is, it almost doesn't matter how much more downside we have, because whatever you own or buy from here, the first good bounce you get, you'll exceed the price. Whatever low you end up going to, you'll bounce greater than the drop we'll have from here, right? So that's kind of where I am with AOI. So like, hey, if they take it down to 14, but 3 days later it's back at 19, doesn't really matter. I'll try to buy some at 14 or 14.50 or 15.50 or whatever. But worst case is if you hold it and it goes to 14 and then 3 days later it's at 19 or 20, the move to 14 doesn't really hurt you. So unless you're so margined up that the move to 14 gets you a margin call, which that's not going to happen to me. So the bottom line is I think it's attractive. It's becoming one of the cheapest names in the fiber optic space. I'm always hunting around that group. Where I used to buy Acacia or where I used to buy Finisar, I still could buy Finisar here too. But I don't know, AOI under 20 is pretty darn attractive because I could easily see the stock. I mean, it was just at 40 something not that long ago. So, I mean, whatever the high was, kind of post my $24 to $28 buys, earlier this year. Again, I think it was 47, 48, maybe it was 50. I mean, stock could easily trade back there again. So, and I'm not super concerned if that happens right away. But there's also a chance this is the last bad quarter. And so, you've seen when stocks post their last bad quarter, even if it's a bad quarter, if it's the last bad quarter, you can get a pretty good up move because the numbers don't matter. What matters is the guide. And if they say they finally have kind of turned the corner and they're through the trough, then you kind of get an all clear move out of that.
All right, and those who may be curious, the earnings release for AAOI is after the market close on Wednesday, November 7th. All right, so staying in the fiber optic space, we do have a question from one of our listeners regarding Finisar. Now, they don't report till the early part of December, but what's your thoughts on Finisar as we speak? I know you just mentioned you might be interested in this one as well, but add some color to that because they're asking, how do you feel about this one?
Yeah, it's probably my favorite diversified or more diversified fiber optics name. So I probably feel comfortable owning the larger or a larger position in Finisar than I do most of the other names. I'm not really worried that it hasn't traded very well. Again, they're kind of a victim of like 3 or 4 things. China trades one. Their own reports, which by the way haven't been bad. They just haven't been big beats. But I actually think it's kind of traded lower on their own numbers, a lot lower than they should. And then just sort of the fiber optic kind of negativism that's in the space has kind of hurt them. But what have we just seen? Okay, so here's the funniest thing with Finisar. And by the way, I pretty much have an overweighted position in Finisar. If I had just a full position, I might not want to buy it. I have an overweighted position. So probably the only reason I'm not buying much Finisar personally is because I've kind of bought it at or lower prices than it is, and I got plenty of it. So I think one smart thing I can say just generally is, hey, everybody should kind of know their own, control their own risk tolerances and not get so over enthused about any one thing that they let that destroy them. So, I'm not going to let one stock destroy me if something weird happens. I think, everybody should have their own advice on this. But my personal view is that, I sort of pick a level at which, hey, no matter how much I like something, no matter how cheap it is, once I kind of hit a level that I kind of feel I got enough, I maybe will add a little for trading purposes, but I just don't keep plowing in and building the position bigger and bigger and bigger. But anyway, with that said, I think it's very attractive. We just saw 2.6 report a really good number. What was that all based on? That was 3D sensing. We saw Light, which was all. So I think Finisar sort of down with Light. Light had a more, again, they're more diversified. On the whole, their number was just sort of okay. I think they guided a little bit lower. But Light had a lot of positive commentary, and they had tons of good things to say about 3D sensing. So guess who's the company that's going to have the most market share gains in 3D sensing over the next 2-3 years? It's Finisar. So Finisar is going to gain share against all the other industry participants in 3D sensing. And, Apple put a lot of money into them so they could increase their manufacturing capability a lot. So I believe after Finisar is completely done with all their manufacturing build-outs and upgrades and everything, they will either be the largest or second largest 3D sensing provider globally. And yet they're priced like they're kind of a mediocre fiber optic shop with nothing going for them. So there you go. So I just think it's a matter of time. And again, we see stocks just do lunatic things now. Things just trade weird. I think Finisar trading, I think anything trading anything below 19 or 20 is sort of semi-lunatic. And I think anything in the 50s is full lunatic. And so, this is a stock that could easily go, the prior highs in the stock were kind of 40 to 45. That was before they were ever in the 3D sensing space that should roughly double the size of the company. So Finisar is basically trading like a company that is the old Finisar that was a solid company, but was a cyclical company that didn't have any growth drivers for it. And it's sort of like the market tends to ignore very obvious things until the 2x4 effect. So at some point Finisar will deliver the 2x4 effect, just like lots of other companies have. It's not that dissimilar to a Micron that was trading 12, 10, 14, 16 bucks before it went to 50. So basically this is kind of the same valuation. That potential. So when Micron was a $10 stock, I said it could go to 40, and Finisar at 15, I could say it could easily go to 45. So maybe not quite as much upside as Micron, but close. So it's that cheap. It's basically as cheap as Micron was at not quite at 10, but let's say 15.
All right. So we do have a lot of questions coming in surrounding Cloudera,
By the way, let me
CLD.
say one thing.
Okay.
I have not sold a share of Acacia yet. So Acacia had a big move, good earnings. It's kind of doing what I thought it would do, where they would kind of get to a point, start producing good quarters, start beating numbers, and hey, you get them a couple beats and the stock could go. I actually don't think Acacia, for given how good the last 2 quarters have been, I actually don't think that stock's gone up very much. So just saying, I mean, this is one I got a $80 price target on. It's not an expensive stock at my price target, especially if they keep delivering numbers as they've been doing. I just want to put that out because it'd be pretty easy, man. I could take some pretty good gains. But I don't really feel any inclination. I mean, I might sell some between 48 and 55, or I might start writing some calls on part of the position. But I think they have a lot of runway. So anyway, just to put that out there because we haven't really talked about that much. And again, kind of as they go, a lot of the other industries should experience similar kind of positive kind of things happening. So anyway, as far as what was the one, Cloudera, I'll let you complete the question.
Yeah, Cloudera. We do have a few questions regarding that and what the reaction was coming off of, I believe there was an upgrade today, and here we are. We saw a big move higher up through 15, and now we are back trading 14. So what's your take on Cloudera, and I guess HDP while we're at it?
Yeah, I mean, same kind of deal. I could buy more of those very easily. I mean, that's probably one of the, again, things just get weird. They probably deserve to kind of have some downside pin action based on kind of the moves in the cloud stocks being sold off, but only to a very small degree. I really thought those 2 stocks would buck cloud selling much better than they have. But again, if they don't have much institutional sponsorship and they can be rated, the algos will rate them. So in other words, it doesn't really matter what a company's worth long term. It doesn't really matter if the merger that they're going to do is going to just organically increase, EPS growth 15 years to the next 3 or 4 or 5 years. It doesn't really matter if the total addressable market from those companies combining is even better than it was standalone. It just if there's no buyers and they can be rated, they will be. So very very strange that both these stocks got hit as hard as they did after Cloudera had their first good report. Hortonworks has had, arguably 7 good reports in a row. They've certainly though had 2 or 3 real good reports in a row. I don't know. I mean, it's my the combo of Cloudera, Hortonworks. You could own. I own a combo of both, because what if the merger doesn't go through, and so then Hortonworks spikes, and then Cloudera does a deal later on or something. But the bottom line is, I'm assuming these companies will merge. I have the merged entity worth 2 to 3x what they're trading at right now. So it was basically 2x when they were trading kind of at 20. So Hortonworks was 25, Cloudera was 20. I easily had the merged entity doubling from that price. And again, they could double from there, and they'd still be trading at big discounts to most of the cloud software names that have similar growth that they do. So again, things are just strange sometimes. I don't really know. I don't know if there's a big risk arb pressure trade against them. So sometimes what companies do, meaning hedge funds and things, is that they put a lot of pressure on the acquiring company, and it's almost like trying to break the buck on a money market fund, or trying to break the $5 barrier for penny stocks. So I don't really know. I don't really know what's going on, because I don't think they need to raise any debt to do the deal. But it is kind of weird. But you almost to the day. I mean, when did the sell-off in the market actually start happening? It started happening around September 1st, 2nd, 3rd. So that's when we started seeing the average stock sentiment started going a lot lower. And then when did the big correction finally accelerate? Around early October. So. And there were a lot of stocks that took a lot of pain as the average stock started selling off, and then as FANG sold off, you had a lot of stocks drop a tremendous amount percentage-wise. And honestly, Cloudera and Hortonworks were, I think, kind of just caught up in that and that sort of that vortex selling frenzy that lasted for, well, the frenzy was about 2 weeks, we really had about a 6-week correction. So, I don't know. I mean, if you just kind of look at how stocks trade now, if the NASDAQ goes down 12%, lots of stocks are going to go down 3 or 4 times that amount. I don't have my calculator in front of me, but I would guess that both these stocks went down roughly 32 to 35%. They probably went down 3 times what the NASDAQ went down. It could be as simple as that. So my guess is they both report well. My guess is this deal goes through. And kind of I used to talk about New Relic as a $26 to a $32 stock, saying, hey, yeah, this company should easily double or triple in 2 or 3 or 4 years. And then I became a short of New Relic at 100 and change, right? So, but New Relic wasn't that tough of a call to kind of forecast that just on valuation basis, given growth, the stock could double or more, from 26 to 35. And I think Cloudera and Hortonworks line up pretty good. I mean, they're just so cheap. They could double and they'd still trade at about 35-40% discount to things like Adobe and Intuit and I don't even know. It'd be a huge discount to something like a Zscaler. It'd be a huge discount to something like a Vive. So, there's still some incredibly expensive cloud software stocks. And Hortonworks and Cloudera are not 2 of those. So, they're very cheap. But I do think people underestimate the potential for just what the combined entity can do. Because here's the thing I think if there's anything that people miss, it's that who was Hortonworks' greatest competitor? It was basically Cloudera. Same thing with Cloudera. So in other words, it's one thing to take out a competitor or to start doing better than a competitor that's been your nemesis. It's another thing to combine with them. So you have the 2 companies that will probably spend the most time beating each other up from a competitive standpoint, and now they're joining forces. This thing could be a monster, this combined entity.
All right, let's stay on Hortonworks, HDP here. So, if I recall, just a few minutes ago, you had mentioned that they've had what you would argue maybe 7 good reports in a row. And prior to that, in our earlier part of this discussion, you had talked about a stock that, or the ability for a stock that may have let's say they report their last quote-unquote bad report, yet the stock will react favorably. So let's say now Hortonworks has had 7 good reports. How many more good reports do they have to go to make this thing move upwards? And, at what point do you start worrying that the market's not realizing that they're having good reports, as you would say, that you have to adjust your own particular analysis?
Yeah, well, in this case, probably not much, because they've taken plenty of pain. They've had puts and takes. So this when I first put my first focus list together, Hortonworks was a member of that focus list. So from the time I'm not sure what the price was when I joined Briefing, but let's just say from the time I kind of got really bullish on the name, it was roughly a $6.50 to an $8 stock. So they'd actually had a number of good reports, got nothing out of it, and then the market just sort of got better. Cloud software stocks started trading better, and lo and behold, what did Hortonworks do? They found a way to go from 7 to 21, 22-ish, where I basically exited my position. So then, they pretty much didn't do. I can't say they didn't do anything, but they spent roughly a year sort of trading sideways to down, and they didn't have great reports, but they were good. But I'm trying to find the exact point. So I was a seller sort of 21, 22-ish. About 3 quarters later, I bought some at 17. And then they actually popped 2 really good quarters in a row. So I had been out of the stock for probably 6 to 9 months. In fact, I had bought some Cloudera instead of Hortonworks at one point. But I bought Hortonworks at 17 right before, probably 2 or 3 weeks before that good quarter that popped it back to kind of prior highs. And then the deal popped it to 25, 26. So I don't know. I don't really worry. I mean, companies like Workday, Splunk, ServiceNow. I mean, they've almost never missed quarters since 2013, since they're a public company. So, I mean, in the history of Splunk, I would say they've probably only missed the quarter and or didn't guide higher 2 times since 2000, late 2012, early 2000 thing. There's a reason why some people really love cloud software stocks, because when you have a good growth, paradigm, or you're in a good industry, you have a good TAM. TAM was the word I was looking for. So when you have a growth TAM that you haven't really penetrated that much, and Splunk still has many, many years ahead of it. I don't happen to own any Splunk, but I could. But I've literally followed Splunk since it was a pre-IPO company. So yeah, I mean, it's not like I think the question you're asking with cyclical tech, you can start getting pretty long in the tooth on good reports at 3, 4, 5, 6. With cloud software, or with just software in general, I mean, some of these companies can report well year after year. I mean, CRM, they've missed very few reports in their history. I mean, how long CRM been around? Maybe a decade or more? I mean, 85, 90% of CRM reports are beat and raise reports. So, in the history of CRM, they haven't had that many bad reports. VMware is another one. I used to love VMware before this new crop of companies came out. In the whole history of VMware, which again goes back to certainly early 2000s, they haven't had that many bad reports. So some of these software companies it's pretty easy for them to have good report after good report after good report. So the better answer to your question is, when do valuations get excessive, or when are valuations cheap? Because the company is generally going to report okay, so it's really more of a matter of, okay, when are people really sniffing the ether and getting way too ebullient about them and believing? In other words, it's a classic deal. Okay, the Bears hated Splunk at 28. And I remember this because I was tweeting publicly about Splunk, how great of a buy it was, and there were ferocious bears, just thought, calling me the most evil names in the world. And, Splunk went, I think, 3-4x to the highs of 2014, which were way too high. So, when the bears basically convert to bulls, that's usually when you want to be careful. And that's kind of what, about a year ago, 3 quarters ago, that's when I started saying, hey, this FANG thing starts to worry me. Amazon worries me. NVIDIA worries me. And then what do? They went up another 40, 50, 60% from those levels, right? So, yeah, but just to answer your question directly, kind of secular growing software companies, you don't really have to worry about the number of good reports. I think you more have to worry about, okay, when are people kind of believing, that everything's possible? When do people start believing that trees actually do grow the sky? When do people start believing that you can sprinkle fairy dust on a company and it magically will be perfect forever? So, we basically hit that point. But see, Cloudera and Hortonworks haven't hit that point. These are basically companies that didn't get the benefit from kind of the cloud love, if you will. So I'm pretty content to be in these companies and kind of own them as pair trades against shorts, Adobe shorts, and other shorts in the group, and until the valuation disparity gets closed, at least.
All right, we do have a question regarding these two, and then we'll jump off into a different stock. Wanting to know, since you already own these, is there a particular ratio, if you were just getting involved in the stocks in these two today, HDP and Cloudera, is there a particular ratio that you would own these particular ones?
I'm not sure the question. I would more say, so let's say in my particular book, if I didn't have any, I would probably want to own, I don't know, probably a quarter to a third size position minimum before each of them report, because I do, and I could be wrong about this. I mean,
but you wouldn't overweight one to the other, would you? You would own them equally.
Okay, if that's the question, I actually would. I would own more Hortonworks, and here's why. Hortonworks is the company that's going to be acquired. Hortonworks is the faster grower. honestly, if I kind of had to pick a company of the two that I actually like more, probably would be Hortonworks. Now, by the way, we all have to know our own biases. It's hard for me not to like Hortonworks because I went from 7 to 22 on it, right? So we have to be careful about that. But I kind of know that. I already know that I've got some favoritism. But by the way, when the Hortonworks went from 7 to 22, it still wasn't expensive at 22. And I kind of was like, I sold it begrudgingly. I basically sold it not because I made a triple. I basically sold it because there was just other stuff I wanted to buy, and it just quit going up. It just, I mean, for a month, 6 weeks, 8 weeks, it just quit working. So I'm like, finally, like, okay, I'm gonna take it off the table. I don't really want to sell it because, God, I hope it doesn't go to 40 while I'm out of it. I mean, that was my big fear. My big fear is that during the 2 or 3 quarters I was out of Hortonworks, somebody would come buy them for like a 80% premium over $20. So somebody would take them out for like 36. But by the way, there's a reason that they agreed to a deal with Cloudera, because they know that the deal with Cloudera will make them a much stronger combined company. They'll have a lot more growth runway, and they'll have a lot more combined market share. They would have never taken whatever that deal price was, 25, 26, whatever. They wouldn't take that from anybody else. If Splunk wanted to buy them, they'd want 80% premium over $20. If Microsoft wanted to buy them, they might want 100% premium over $20. So the reason the premium was so low is because there's so many synergies to this combined company. But yeah, if I were to just buy, if I were to say, okay, how much of one versus the other, I would say like 2/3 Hortonworks, 1/3 Cloudera, or even 3/4 Hortonworks, 1/3 Cloudera. And by the way, maybe there's some of this in play. Maybe somebody else wants Hortonworks. So maybe they're trying to put enough pressure on both these companies' stock prices to make Cloudera give up, and so somebody can scoop up and do a deal and buy Hortonworks. I mean, hey, if I was a big company right now, and I'd be freaking out, and I'd say, I'm not sure I want these two companies to combine. So, yeah, I mean, some of this may be going on. Maybe there's some pressure being exerted to specifically Cloudera as the parent, because you want to get them to give up the deal, and somebody can come in and buy Hortonworks or something. Who knows? We'll see. Or maybe somebody's trying to pressure this thing, and maybe they're going to buy the combined entity. I don't know. But the bottom line is, yeah, I would favor Hortonworks over Cloudera at current prices.
All right.
And sorry, I didn't understand the question, if that's what they meant.
Oh, that's
so
okay.
Thanks for clarifying.
Yeah, no problem. So I wanted to ask you about FireEye. We have one listener asking if you would add more to the little pullback we have here.
I would. In fact, I almost bought that today. I don't have the best Wi-Fi connection. I don't have my full trading rig with all my screens in front of me. But here's what I basically think about FireEye now. So this is kind of what I was waiting for, and I don't mind buying stuff higher. I was kind of waiting for the quarter that they had, and I was waiting to see. So they reported good again. I thought they reported well last quarter. They didn't get anything out except for selling. There's more positive reception around them this quarter, but they still. I mean, what they go up $1.50 or something? I think they've gone up here. Let me pull up. I think they've gone up a net sort of $1.50 from the report. This is another exceedingly cheap stock. A lot of growth runway. I think a move to 30 is underway. That's what I think. I think it's going to 30, and I think it could go higher than 30, but they got to have growth exceed 8%. I think total top line growth is something like 8% now. They got to have revenues growing more than 8%. So now billings are growing more than that. Bookings are growing more than that. Their pipeline's growing a lot faster than that. But they've just got to start getting to a point where they cross the chasm. They have enough quarter of higher subscription rates now. The renewals look good. But they got to get to like a 13, 15, 17% revenue growth rate. And I think you can see the stock trade a lot higher. So I think the last thing kind of plaguing them is I want to say I'm pretty sure their revenues were 8%. I don't have anything in front of me, but I'm pretty sure they reported revenues were 8% year-over-year growth. That's pretty skinny. I mean, that's okay. But yeah, I'd rather see that number 14, 16, 18%, something like that. And again, the bookings are there, the billings are there, deferred revenues are there. The package is there. They just got to convert everything and start seeing better revenue. Now I pretty much know that revenue growth will come. But again, most people in the market just don't. They don't want to They don't want to. They don't want to do something until like it's already too late. Like in the old days, FireEye would already be $25, $27 because there's enough information there that the people that know what they're doing, they know what the numbers are kind of going to be based on because it's a software entity. But in this day and age, people just, I guess, aren't, I don't know, they just don't forecast as well as they used to. And so they need to see it. They need to see it. They need to believe it. They need to hit across the head with a 2x4, and then they go, okay, I get it now. So, probably in 2-3 quarters, FireEye will probably start producing that kind of low to mid-teens, maybe even upper teens revenue growth, and the stock can rate higher. But yeah, I think a move to 30 is underway. I want to add to it. I'm waiting for a little bit more of a dip. I don't think I got to worry about them filling the gap, but something maybe a smidge into the gap or something like what. You help me. Where did they? I want to say they gapped to about 1780. This is purely from memory on when they reported the day after. So anything close to 1780, I'd probably be pretty. Personally, I'd probably be pretty interested in grabbing more FireEye.
Yeah, just based on the chart, 1780 is a pretty critical level. So yeah, that's where we get the gap up.
Okay, so yeah, I remembered that correctly. So yeah, anything there, anything around, if it went below that, it wouldn't bother me, by the way. I mean, here's what I worry about with FireEye. I actually worry that they're going to get bought. And the reason I worry about that is because if they get bought probably inside of 6 months, that will still be early enough that the superior bookings and deferred revenue and billings growth won't have time to translate. Again, what happens when companies that go to a much higher rate of subscription-based revenue is actually hurt short-term growth. So long-term growth is improving, but short-term growth is worse. And so there's roughly a 6-month window that somebody could come in and try to scoop FireEye until the numbers actually show up. The growth they're actually producing the last 6-7 months, 2-3 quarters will translate to the actual revenue growth that's going to occur. So, and I don't want a deal now because somebody might be able to scoop them up for less than $30. So, whereas if a deal were to happen a year from now, and FireEye is already 27, 28, 32, something like that, well, then they got to pay a premium over that price. So I really hope nobody comes and buys FireEye in the next 6 months because it's probably the last period of time where somebody could get a kind of a crazy good deal with them. Kind of similar to what the Imperva sold for. I still think Imperva is nuts to sell for 55, but they did. Can't do anything about it. I took the money and ran. What are you going to do? So, sometimes some companies have better management teams than others. FireEye does actually have a very good management team now. So I'm not so sure FireEye would actually succumb to a cheap deal. But I just hope a deal doesn't come along in the next 6 months because you'll get a worse price, or the people who own FireEye will get a worse price than if it drags out a little longer.
All right, we do have another listener question asking about Ambarella, A-M-B-A. Considering your thoughts, particularly since it's been part of your portfolio for quite some time, hasn't heard a lot from the company, says things have been pretty quiet, and he's just kind of curious as to why. What do you think of the stock right here around the $35 area?
Well, I like it. I think I posted a position increase in this not that long ago. It was a little bit higher. Or it was certainly higher than 32. It might have been around here. Might have been 37, 38. I can't remember the exact price. I like it. I mean, it's one of my... Okay, so now that we've seen Qualcomm work, now that we've... I don't know if the SOX as an index has bottomed. This is another thing. I think, sometimes you get... I call, like, the one trade I called was the Apple paradox. So what did we see? We saw Apple trade very, very strongly price-wise. And, I mean, the market almost literally just forgave them for 3 very mediocre quarters. They're finally kind of caught up with them now. But what did we see the last, basically, 3 to 4 quarters? The Apple suppliers haven't traded well at all. Well, okay, so I think that trade's going to reverse. With AMBA, it's almost like the SOX paradox. So, there's still been a few companies that I've liked in the semiconductor space that have not traded at all like the SOX. And remember, the SOX is very it's a very skewed index. It's the market cap. It's like hyper market cap weighted. So it used to be as Intel goes, so goes the SOX. Well, guess what? NVIDIA became a very large market cap stock. So then, as NVIDIA went, so went the SOX. But a lot of semis do trade in line with that. But I was, it's interesting. I've had some time to look at a lot of charts. AMBA's very interesting. I still like it. They have their own growth story, so I like it for its own unique reasons. But so here's what's interesting. AMBA took all its damage, really, before the big sell-off occurred. If you actually look at Ambarella and track and do some relative strength calculations on it from September 1st, stock actually held up pretty well. And then from, especially when the selling got really vicious, especially in the semis and the NASDAQ and tech, and starting early October, Ambarella didn't really go down at all. There were multiple days where Ambarella was green, while the SOX and tech was like 95% red. So one, that's an interesting observation in and of itself. Two, again, I like Ambarella for its own reasons. And three, I think there's possibly a big catch-up trade just because certain names that lag the SOX now can probably outperform the SOX. Sign is another one. Qualcomm still has hugely lagged the SOX over like a two and a half year period of time. And then, stocks like NVIDIA, Texas Instruments, ADI, there's a lot of companies that went up way more than they probably should have. So we're going to see a lot of jostling around with the semiconductor space. Again, I think we'll see Apple suppliers do better. I think AMBA could be a big winner. AMBA's got some unique things. They've got a security play aspect to the company. They were kind of all GoPro at one point. Then they basically had to kind of live without GoPro revenues, and they've transitioned through that phase pretty well. It was also a darling that became a crash stock, and those things can be kind of rough too. Ambarella went from a stock that was cheap, that was actually a fairly valued cheap semiconductor, and then it got way too hot, went to 120, 125, probably didn't even deserve to trade at half that value. So then it kind of had to earn its, it's basically had to kind of go into like fight and survive mode for like the better part of the last 2 years. But no, I like the name. I think they've got a lot of positives. I do think that's one I think is a definite acquisition candidate. And they could trade quite a bit higher on a takeout. So Sina, AMBA, Qualcomm are kind of my three semis. Recently though, like something like an Applied Materials, Micron, there was one other one I spotted. Oh, iCore, ICHR. Those three look very attractive to me. I think I bought and sold ICHR sort of high teens, low 20s, sold it sort of mid to high 20s. God, the other day, I literally almost bought some, I want to say, a 1620. It's already popped about 2.5 points. Anyway, ICHR, AMAT's another one. You couldn't hear anything about how much media bull love the late Momo guys had for AMAT as a $55 to a $62 or $63 stock, and it's crickets now. So they cut it in half. It's a way better buy now. It's just as good of a company as it was. Yet there's nobody. I don't see any love for AMAT at $35 or $32. AMAT's probably a pretty good buy. I'm not sure I'm going to buy any, but if I were to buy AMAT here, I'd probably make money on it. I wouldn't really worry about taking a huge drawdown or not getting paid. I'm not sure I'd be able to double my money because I'm not sure it deserved to be at 64. But I don't know. Hey, when what's Jim? What's the expression I like to say? Hey, if it's 64 now it's 34. It's a better buy now than it was before. So there you go. And that's a way better buy. And that's a high quality company. Same thing with Micron. Remember all the bullish love on Micron at $60 when I was shorting it? I didn't milk that short very good, by the way. But The bottom line is it's a way better buy in the low 30s than the mid 60s. So my Micron sets up pretty well too. Again, I think they'll get a lot of good business from Apple. So again, I'm actually becoming more interested in the semis as a lot of other people are getting less interested in them as the stocks are being cut in half.
All right, well, let's move away from semis. I got two more for you. This one's on SunPower, SPWR. Stock's up nicely today, over almost 8% actually. And the question is, what do you think the overhang in the stock has been? SPWR.
This group hasn't reported well. There has been some favorable news, but it hasn't translated to any results. A big turn in results yet. Sometimes you're just going to be wrong on stuff. I hope I'm not wrong on SunPower. I don't think I am. I'm not down a ton on the stock personally, but this just feels like a stock that has a lot of upside. But I just don't know why there's not more solar activity, to be perfectly honest. This is one I've just got to say I'm scratching my head a little bit. I'm waiting. Maybe there's some political stuff going on. Maybe this is a stock that can trade better after the midterms. And I'm not saying it needs a Democratic sweep or anything to trade better. I'm just saying that maybe there's just been things happening. The political environment hasn't been favorable for the solar industry. Here's one thing I almost know is hurting them. I can't prove it, but I don't think Solar City inside of Tesla is doing very well. And that was a growth. Solar City itself was a growth engine for U.S. solar suppliers for at least the better part of 2 or 3 years, if not longer. It's probably not a big growth engine for the solar capacity providers anymore. The guys that sell the gear, right? Like First Solar and SunPower. There's a few other, CSIQ and some others out there. But I just don't hear a lot about big solar projects getting done now. You would think they would need to be. You would think that's still going to be a big growth area over time. But years ago, Europeans were all hot on solar. The Chinese were all hot on solar. Honestly, I just don't hear a lot. Maybe it's just we're going through the last phases of a down cycle or something. But this is one group. Sometimes I kind of play things just based on history. And the one thing I'll say about SunPower and solar specifically, I've never seen a tech rally finally hit cycle highs or the market itself hit cycle highs without solar participating. And you could go back and what was one of the last hot groups in 2006-07? Guess what it was? It was solar. Same thing. 2014, when spring of 2014, the stocks that actually were doing well were solar. So as other tech was coming down, solar was going up, and again it faded hard. So usually you get a good solar move at some point in the late stages of a tech cycle. Put it this way, I can't say it hasn't always happened because there were tech cycles I lived through that didn't really have solar at the time. But since solar came to be, we have not really had a tech cycle end without solar getting some participation. It's possible this could be the one where it just never occurs. But I don't know. There's not, the thing I like about SunPower, and I'm starting to warm up more to First Solar over time, especially as it comes cheaper, is there's just not as much capacity anymore. So, sort of like the railroads. Once you eliminated a bunch of railroads, the ones remaining did better. Same thing with semis. Well, why have semis traded so well in recent years? Because a bunch of them finally consolidated, right? That's one of the reasons I like fiber optic space. There's been a fair amount of consolidation in the fibers of the last 6, 7, 8 years. So there's just not. There's not a ton of. There's not nearly as much competition for the solar capacity providers as there used to be. The crash of 2008 took a bunch of capacity out of the industry. But I don't know, for whatever reason, the solar industry itself, the growth, panel growth, right, capacity growth, power generation growth, it just hasn't really been it hasn't been in vogue recently. I don't know why, but it must have to do with the power companies and political issues and stuff like that, and stuff that I frankly don't pay much attention to. But I like their technology. I think they're a global technology leader. They're a survivor long term. I think their day will come, but I might be wrong that like, I thought they were really going to put in a decent move sort of between when I started liking them about 2 quarters ago, either into year end or the first 2 quarters of next year. I don't know if that time frame is going to fulfill at this point.
All right, so the last one, and I'll get you out on this one. One of the listeners is probably a little anxious on the moves that we've seen in the stock markets with, I'm just looking at NASDAQ futures and we're down 75 today, but I'll pose the question to you, and that is, do you see a chance of an 87-like crash or an '08 type financial crisis? How bad do you think this can get?
Well, I'm going to toot my horn a smidge, and then I'm going to get to the broader question. So first of all, I'm going to say that I've been pretty good, and you know that I've been pretty good at calling these corrections this year. So when a lot of other people were not calling them, I did. I was really good in the first 2-3 corrections this year, and we're pretty close on timing. I was literally within days, or the first 2, I was literally within days to hours. I think the third one I was maybe within a week or 2. The fourth one, I was probably early by what? You tell me, 2, 3, 4 months. I mean, it took. We finally ended up getting a big correction, but I thought one was going to happen quite a bit earlier than it did. So I'm not gonna pat my back too hard on the timing of it, but the fact that I mean, it was just too obvious that we had huge issues with the valuation of a very small number of stocks. So I'm going to kind of stick with that thesis in that I don't think we have a huge issue with financial conditions in the marketplace. Hey, the last big crash we had was because of a global financial crisis and huge inequities with how money was borrowed and no doc loans and a huge real estate bubble and blah, 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 blah. Well, guess what? Typically the thing that took you down the last time is not the thing that takes you down again. I like to say it's not the train you see coming that hits anybody. It's something that you don't see coming that hurts. And guess what? We did all sorts of things politically, globally, with financial systems to sort of make sure that an '08 isn't likely again or isn't going to occur. So my guess is, hey, it doesn't mean doesn't mean we can't have a deeper correction than we just had. In fact, honestly, I kind of thought we were going to go a little more. I thought we were going to hit NASDAQ kind of 18 to 20% down. I thought we were going to hit Russell 2K sort of 25, 30. Russell 2K did get pretty beat up. And I thought we were going to hit S&P sort of 12 to 15%. I don't have the numbers in front of me. Did we get to 12% on the S&P? I don't think we did.
Think so.
I think we got to like 10.8, maybe 11.1, something like that, or 10.3. So I kind of thought we were going to get like 12.5, 15. But see, look what's happened. Look how many stocks dropped. Look at the magnitude of the decline in the average stock. Look at, Amazon did finally drop off. By the way, Amazon can easily drop another 800 points and not be cheap yet. But I see if something really ugly were to happen, if I were just to guesstimate, I would say it would be a global security scare or a coordinated terrorist attack on multiple big cities over a multi-day or multi-week period. In other words, it's something,
some type of black swan
bombs. Yeah, suitcase bombs out of nowhere that nobody expected that hit 8 big cities around. I mean, again, something totally different. And and Ken's, Warren Buffett is famous for saying, look, a nuke will go off somewhere sometime, right? Maybe not in our lifetime, but bad things are going to happen. Hurricanes happen, global calamities happen, financial crisis happen. My guess, though, is whatever the thing that took us down the last time is probably not the thing that's going to take us down this time. So I definitely don't see an '08 at all. I don't know if I kind of think we've put in enough downside. Honestly, the fact that we all the market index lows were not in any way matched by again, the sentiment low never retested. That's super bullish. I also like the tenor and the structure of the sell-off and what's recovering. We're having rotation. The fangs are bouncing weekly, and Apple's also going down. Microsoft had a great report. I don't think it was up more than a day or two after the report. It's kind of sideways to down ever since. So super expensive, overvalued stocks are not acting well. That's and by the way, that in my mind was our only problem. We had a huge problem with overvaluation with a bunch of leading stocks. The narrow leadership. I can find hundreds of companies that are trading exceedingly cheap. I don't think real estate's in a bubble. Might have gotten a little too hot in certain places. But I don't know. Anybody that's out there that's trying to kind of spin the U.S. is like, hey, the same conditions that existed pre-2008 are all happening again. I don't buy that at all. I think, in fact, anybody that's trying to perpetrate that are probably trying to sell a book or something, and I wouldn't believe them. Anyway, I don't want to get what was the question exactly? So there was do I think a 2008 is coming? No. What was the other part of the question?
An 87-like crash.
87 was a very unique, very specific financial instrument contributed to that particular setup. I mean, same thing. We had the flash crash in 2010. I was literally trading that day, and I bought some stocks that day. There have been a lot of things put in place since 87. There was also some stuff put in place since 2010's flash crash to sort of help prevent something like that. But yeah, I don't know. I don't think we have an 87 setup personally. In fact, here's what I would say. I would say a lot of the corrective activity that we just had sort of was the overvaluation of a very small group of stocks leading up to it. What you could say was somewhat similar to 87. In 87, though, I don't think the leadership was narrow. I think it was extremely broad. I think you had lots of stocks up in 87. You had a big market run from 82 to 87 preceding that. So I don't really see this was just a really narrow deal. But yeah, no, I mean, by the way, what do we have today? We have algorithmic trading. Algorithmic trading does all the trading now, right? Algos can drop bid extremely fast. They can drop bid. So in other words, let's say there's just no natural buyers because nobody wants to trade. Well, an algo would say, well, wait, I'm setting a price. I just dropped the price 50 cents on stock and there's no buyers yet. So therefore, maybe I got to drop the price 50 cents 100 times to find a buyer. Well, sometimes there's not sometimes you don't have a buyer isn't because a buyer doesn't think there's value. Sometimes you just don't have buyers because nobody wants to buy anything right now. You know what I mean? Mm-hmm. So in other words, this whole theory that you have to drop price to a point where volume kicks in and that's how you find value, I don't agree with it. In other words, sometimes buyers just rest. Sometimes buyers just aren't. Sometimes they're in the Hamptons. Sometimes they're on vacation. So this whole theory of forcing bids and asks to prices to find volume, and that's where the natural buyers and sellers is. I disagree with that. I think that's a great way to find unnatural buying and selling. You can find unnatural short-term buying and selling there. It's very possible that the next crash has nothing to do with anything economic and has everything to do with just how bad a market structure is now. And I think it's terrible. We don't have an uptick rule. We don't have specialists. I mean, I could go on and on and on with something like this. I mean, we don't have humans really checking things. We have people worried about microsecond transaction speeds but not worried about the inequities that occur. We have people worried about, hey, well, it's okay if Apple has great trading all day, but what if a stock like MTSI has, horrible trading, right? Mm-hmm. Where's the liquidity and where's the liquidity in thousands of small and mid cap stocks? Where's it gone? It's gone, right? It's only there when the natural buyers of mutual funds and and people who are interested in those stocks show up once in a while. They don't have unlimited pockets, right? So anyway, market structure is very bad. We could easily have a flash crash and multiple flash crashes really at almost any time. I mean, somebody could flip a switch the wrong way. Somebody could set off programs the wrong way. You could have a big vortex deal that triggers more vortex type selling. You could have a bunch of ETFs and mutual funds freak out, and you could have a very sharp downward deal that has nothing to do with anything, just because price is set by a bunch of computers trading against each other. So, I mean, hey, I'm not really worried about Skynet. I'm not really worried about Terminators killing all the humans, but I do kind of worry that Skynet might already exist in the financial marketplace. And what if somebody were to get in our system, right? I'm getting a little esoteric here, but what if terrorism could enter algorithmic trading and start creating panic programs to trigger fear, right? I mean, the trick would be to keep that going long enough to cause massive economic damage. But I'm just saying, I mean, that's if I were the regulators, if I were the people minding the store, that is the stuff I'd be worried about. I'd be worried is, do we have unbelievably undeniable security from outside forces getting into our financial markets? Can somebody else get a hold of these algorithms and trigger trading that should otherwise not occur? But I mean, it's just, I mean, we really should have an uptick rule. I mean, if they want a cure-all to help this, to prevent that bad actors couldn't damage our stock market to the degree to put us in a severe recession, they probably should look at the things that would help prevent it. I mean, there was a very good reason the uptick rule was put in place post-1929. So, and all the conditions exist today. So they basically kind of eliminated the uptick rule to make it easier, I think, for algorithmic traders to trade more frequently. So guess what? But I mean, if they can program the way that the things they program, they could easily program with an uptick rule in place. So, I mean, by the way, the single worst decision I think that was made pre-financial crisis, which I believe actually had a huge impact on the severity of the financial crisis, which nobody talks about, is the elimination of the uptick rule. The uptick rule was eliminated in Q3 of 2007. And all one has to do is just look at trading from that point, from the date of elimination to pretty much March of 2009, and pretty much every single correction we've had since. And the not having an uptick rule has aided in the fear. And the whole argument, the people who are anti-uptick rule, they always say, well, wait, how come we don't have a downtick rule? Or, well, it's because, fear creeps into markets. Fear affects price much more than greed does. And guess what? We had plenty of stock market crashes after we implemented the uptick rule. We had plenty of recessions after we had an uptick rule. We had plenty of global calamities after we had an uptick. So in other words, the uptick rule never prevented stocks from going down a lot. I mean, we had an uptick rule in 99. Tech stocks went down, 70, 80%. We had an uptick rule in the 1970s. What that was one of the worst. Until 2000, the correction in the early 70s was the worst since 1929. So in other words, the uptick rule didn't prevent correction. It didn't prevent market crashes. It just provided stability in how fast prices could go down, but without having a check and balance on them. So anyway, not to get too long-winded on something like that. But yeah, I don't really worry too much about that. And I actually think the correction that we just had was really a very necessary. In fact, what did we say a couple calls ago? I said, I think we actually could go higher in the markets if we had a really good correction that took down the right stocks, right? The stocks that deserve to go down. So I'm actually way more bullish now than I was probably before we talked the last couple times, because, until Facebook dropped 60, 70 points, until Amazon dropped 500 points, until Google dropped a few hundred, until the cloud stocks dropped, 15, 20%. I was kind of worried. I mean, I didn't know how big of a drop we were going to have. But what the interesting thing is, we had a pretty big FANG drop and a pretty big cloud drop, and things held up pretty well. So honestly, I kind of thought, if you'd have told me Amazon was going to go from 2,000 to 1,400, I actually thought we'd have far worse market action than we did.
All right. Well, I think that's a really good place to leave off then, because I think it really brings home where you are as far as the overall market and leaning a little bit bullish if I can kind of put words in your mouth a little bit there. Well, since you are in the Dominican on a little mini vacation, I will let you go for now. And when are you coming back?
I will be back in full operation mode Thursday.
All right. Well, let's see how things go down as the week progresses. This is kind of the last big week of earnings. I know there'll be some more as we trickle into closer to the Thanksgiving holiday. But for the most part, we'll have a lot of the heavy hitters out of the way by then, and that'll give us a good chance to let you regroup, see what's going on, and get ready for what you may have in store for the holiday trading season. So, as always, Sean, thank you so much for joining us.
Hey, thank you, and I'm glad. Here's what I'm happy. I'm happy we didn't have any Wi-Fi snafus. So it sounded like I was able to hear you, and you were able to hear me the whole time. So that was good.
Yeah, I didn't hear any hiccups at all. So yeah, good stuff from there. Whoever you're paying there to get the good Wi-Fi, express our love.
All right, thanks, man.
All right, thanks a lot, Sean.
All right, see you.
Okay.